G'day Louis, good to chat. Obviously news out of the Reserve Bank of Australia is that the cash rate has been increased again for the 5th consecutive month. I wanted to pick your brain on what does this mean for investors, and I guess more specifically, is this typical during periods of interest rate increases, and how long do you think it's going to last?
Absolutely, in terms of the rapidness of the interest rate rises, because we've all heard the saying, go hard, go fast, go early. And that's exactly what the Reserve Bank's trying to do. They're trying to get on top of a perceived threat from inflation by affecting consumer sentiment. So central banks around the world are all trying to jump on this really quickly, get on top of it early so they don't have to put their interest rates up as far in the future. What can we expect? If I go back through history, what we've seen through the mid-2000s and then even post-GFC, when Australia's housing market started to take off again, they've tended to put interest rates up in a number of consecutive months, then start to ease or pause. And then they see what impact that has flowing through the economy. Because a lot of the indicators they look at are lagging indicators, they don't actually have the data yet from almost the first or second interest rate rise. So they'll have to start to look at that. And it's certainly what a lot of the banks are now starting to forecast, particularly CBA, who's saying that they've got up to the minute data on credit card expenditure and other things, and they're seeing that there has been a pullback in activity from consumers, and that when that data starts to make its way through the ABS, which takes a little bit longer because they're waiting for all the banks to report up to them, then we'll start to see the RBA taking a bit more of a breather. But as I said, no surprise about this one, and it's probably not far off that period of pausing.
Yeah, and I guess for well over 25 years now, probably closer to 30, you've been studying different market cycles and what happens. They've got to sell papers, the media, so everything's always different, and it's the first time we've seen it. What's the reality around the landscape right now? Is it any different, or is it kind of lather, rinse, repeat?
It's an interesting thing, isn't it? This is about market psychology, and this is like one of the most important things to understand as an investor. And people like Warren Buffett talk about it. He uses a term, be fearful when others are greedy and greedy when others are fearful. What the term my dad uses, or the terminology, is that everybody thinks it's different to the last time until it's not. And that stands true when there's a boom, and we're seeing prices going up, and everyone looks for a reason why this boom will never end. And then suddenly something happens and it causes the boom to end. In this case, it was that fear of interest rates going up and that shifting from the RBA and central banks into starting to put interest rates up, that everyone started to go, well, actually, something's different. And it takes time for the market to absorb that, understand what it means for them. Now we're in that phase where the media pundits are all saying this time it's different. We've never come off such a low base of interest rates, so it's very different. Interest rates are going to keep going up for a long time. And the reality is, it's no different from previous cycles. We go through this period where the RBA, or central bank, puts interest rates up, they pause and see what effect that has. And once they start to take that pause, and this is the key thing, that the market needs a sign, often a signal, that things are actually not different to last time. And when the market sees that pause in interest rates, that's when we actually start to see people starting to pour back into the market. And we have to remember, we've got record low vacancy rates around Australia. We've got a housing shortage. We've got fewer dwellings being started than what we need. And we've just had an announcement from the federal government that they're going to increase the permanent migration take by 35,000 places. And if that's 35,000 job places, that's 35,000 people coming in to earn money on top of their partners who might also come in down the track. But it's quite 35,000 extra bedrooms that are needed, if not even dwellings that might be needed. And we're not producing enough for the current population with low population growth for the last couple of years. So that's obviously going to it's like pouring oil onto a fire. when that comes through. So we've got this really small window of time right now where a lot of people have bought into the hype that this time it's different and that this interest rate cycle is going to have a different impact on the market and might go for longer. Market softness, such as we're experiencing right now, typically lasts for 9 to 12 months. We're 8 months into it from the peak of the Sydney market, which means that we're probably closer to the end than the start, and that once we see that interest rate tightening start to ease up, that'll be a really strong signal for the market. And the opportunities that are there right now for investors to take advantage of probably won't be around into next year when the enthusiasm from the market really starts to pour back in and people's, I guess, sense of reality, knowing that there's a lot of pay rises have been coming through, rents have been going up, and the situation's not as dire as they might have feared. And that's what we're talking about here. It's people's fear as opposed to reality. And yeah, as I said, it's going to be short-lived. That's certainly my experience in it's just been 25 years of investing directly and 30 years of monitoring and watching and studying property. So yeah, it's not going to last very long.
Yeah, I think something we were speaking about late last week as well is really relevant here, and that's it's not well known out there that about a third, rough numbers, about a third of properties in Australia are owned outright. There's no mortgage on them, right? Round numbers, another third are properties that are rented, owned by investors, who, as you said, have probably seen a pay rise and get tax benefits on negatively geared property, or they're very cash flow positive and interest rate increases aren't affecting their cash flow, or the interest being tax deductible, obviously, or the rent has gone up, so their cash flow position is not negative to what it was 6 months ago. So really, there will be a handful of people out there that have bought recently and didn't necessarily budget this and expected that interest rates wouldn't go up until 2024. That very small portion of the population is likely to be affected at some level. But we're not going to see, mass levels of property supply hitting the market through mortgage distress, which is often what the media talk about. And is required to see prices come backwards. So I think it's a really, really good point you raise. You talked about opportunity just then. Let's finish with that. Where do you see the opportunities right now, and what are the key takeaway messages for investors today?
Oh, well, look, I think that the price of housing has been going up. So the entry-level price has been going up really rapidly, and the cost to replace a house is going up and will continue to go up into next year. We're also seeing that entry-level market, or the affordable end of the market, being the most drastically affected by the rental scarcity right now. So we're seeing rents going up exceptionally quick. So in terms of opportunities, it's getting into a market or into a property where there's low vacancy rates, where rents are rising rapidly, where the replacement cost of housing is continuing to rise, and where there's scarcity of future supply as well. And obviously there's not just one market that fits, there's multiple, but it's mostly also finding those regions that are serviced by infrastructure, because there is a really big infrastructure spend still happening around Australia as well. It's going to continue to support jobs, and those jobs are going to help to drive up rents even further. So that's kind of where I would be focusing. I'd steer clear of the premium property markets right now, and focus where there's that bottom-up pressure on the market.
Wonderful. Well, thanks for joining us. Obviously, today's announcement will be scaring some people. As you said, it's all about fear, and hopefully what we've been able to share today helps put some reality around the way that we see the market and the opportunities out there. We'll see you next time.